You're listening to Lender Lounge with Kevin Kim, a podcast dedicated to the private lending industry. I'm Kevin Kim, and my goal is to sit down with key figures in the private lending industry to talk about their business and their personal lives. We'll get their takes on market conditions, the industry at large, and their personal stories. Overall, I really want to learn more about how they started and grew their businesses. So whether you're a lender, a borrower, a vendor, an investor, or anyone just interested in learning more about private lending, this podcast is definitely for you. Thanks for tuning in and enjoy this week's episode of Lender Lounge with Kevin Kim. This episode is sponsored by PrivateLenderLink.com, where investors and brokers find direct private lending companies throughout the United States. In addition to promoting lending programs, the site also has a unique directory which lists private mortgage investment opportunities. Mortgage investors can use PrivateLenderLink.com as a resource to discover mortgage funds as well as lending firms that offer mortgage and trust deed investment opportunities. Review multiple investment profiles, do some research, and contact each company directly. And for all you loan originators out there who are seeking additional investors for a fund or notes, PrivateLenderLink.com is a great place to advertise your investment offering at a very reasonable cost. So get on your browser and type in PrivateLenderLink.com/investments. There's no fee to search and registration is not required. All right, guys, welcome to another episode of Lender Lounge with Kevin Kim. Today, we have a very special guest, Chris Hanson with Hanson Capital. We just left a epic session of networking and having one too many drinks at our Captivate conference, and got to know Chris pretty well and wanted to have him on the show right away. So, Chris, please introduce yourself to our audience and give us a little bit of information about Hanson Capital.
Hey, Kevin, thanks so much for having me. Good to connect again so soon. Hanson Capital started in 2008, kind of vertically integrated investment company. We've got three main buckets. We run funds for debt. We run funds for value add assemblage, both multifamily and industrial focused. Mm-hmm. And then we develop ground up, kind of opportunistically. Right now we're building the build for rent, detached, low density product. Those are kind of the three main buckets. And that's Hanson Capital in a nutshell.
Fantastic. And so you guys are famously known for being on both sides of the business, right? Very few companies are still, like, some guys start out building and they transition to debt, or some guys start in debt and transition to equities. You guys are famously known for doing both, right? And what did you guys start with? Was it being a builder, or was it being a lender?
Good question. So we started out buying foreclosures in 2008. I was buying for myself and kind of saw a void in the marketplace to start doing service providing and, auction management. The Phoenix, Arizona, which was the first market we were in, Phoenix foreclosure market, had like 15 trustees down at the courthouse steps. And, it was a lot. Our list was published nightly. The old, go drive it first thing in the morning, take pictures, show up at the steps. You've got to have checks in hand. So I saw an opportunity to create a business to provide that service to investors. Mm-hmm. And shortly thereafter, I had an investor who said, "Hey, do any of your other customers want to borrow money?" And he was a well-capitalized guy. And I started lending as a loss leader. In those days, I was paying him a fee, doing 18% interest only loans, right, doing all the servicing and not taking anything on it. I considered it a loss leader to facilitate more auction transaction business, right, but it got me into the banking business. And prior to starting the real estate acquisition, I had been in mortgage banking.
Okay. So that's what I was going to ask you. So you, what kind of mortgage banking were you doing before all this?
Wholesale mortgage banking with Wells Fargo.
Oh man.
You
were in the trenches then.
05 to 08.
Oh,
I was doing that.
You saw the worst time.
Best or worst, depends how you look at it, right?
05, it was crazy. And then you're also just running around trying to figure things out when you're from 05 to 08, because everyone was like, what the hell's going on?
Yeah, that was and I was fresh out of college in 05, and there was a lot of money being made in in mortgage, and I thought it was easy, and then went after the foreclosures. First house I bought is kind of a funny story. I was making a good amount of cash and I was spending it at a pretty good pace as well. I quit mortgage in February of 2008, kind of saw the writing on the wall. If this is getting
you
ugly.
Walked out. You weren't laid off. Okay.
Yeah, no, I decided it wasn't for me. We were prime product. We weren't like subprime guys or anything. And I was dealing at a wholesale level. So I wasn't front lines, doing the no doc, state-rated liar loans and all that kind of stuff. But I just wanted to get into the real estate stuff. I'd always wanted to get over there. So I cash advanced a credit card to buy the first foreclosure house.
What?
And
what was it, like 32% interest?
They B of A, and they still send those letters now and then. They send you that letter like, hey, if you can write a check, a convenience check, they were called. So I wrote one of those for like $50,000 and bought a $36,000 house. And I sat there at the first house and watched we need to get carpet, we need to paint. I had no idea what I was doing. But
that's a pretty interesting way. Like it's a very different story than compared to like a lot of our folks who jump in. I mean, common story is you get into the auction game, right? That's a very common story. 08, 09, a lot of guys started the business with, we're buying houses on the courthouse steps. I mean, we still have clients who are doing that approach and then transition into lending. But the fact is that you did it as a single investor. I mean, you're so young, you're 25 and you jump into this space head on with enough you have the bravery to, I think it's courage, and only a young man would do that, right? You're not going to do that in your adult years, but like a young man is going to take that risk. But you literally, you've never built a house before. You would never flip the house before. Tell me about that. Like you were sitting there watching them repair the house.
Yeah.
Did you know how to like work? Did you know how to hire contractors, or were you doing it yourself, or like what was the story there?
I called a guy. I actually learned a really tough lesson in that business. But I called guys off Craigslist, I mean, at that time, probably at all times of the foreclosure business, you get, you walk into something and who knows what you're going to find. Right. And I had a house that clearly needed carpet. It was probably like a crack house or something prior to, and I hired a guy off Craigslist, and he kind of was a jack of all trades. And, you kind of fumble through that stuff and figure out like, this guy's not a good vendor. This guy just took my head off on something. Oh, this guy's a little more reputable, and learning to negotiate through that stuff. I just kind of had to figure it out the hard way. I didn't have anybody coaching me or giving me instruction. I would say this is pre all of the kind of fake, influencers and real estate gurus and everything. That wasn't really a thing back then.
2008, we're still reeling through it, right? So being at the auction steps was actually not really a move. Some guys were doing it always, but like 08 was when it started. You didn't really, you saw some classes,
but they weren't educating people. They weren't teaching you how, right? They were making money and that was that. And then, the pace at which that was going in 08, it was still depreciating. So at that time, I think Phoenix was selling 3,000 houses a day. Were on the list, the daily list of foreclosures. Now they wouldn't all sell, but there was 3,000 homes a day to sort through in an Excel sheet. We'd assemble it all from the different trustees and kind of aggregating all that data, figuring out how to underwrite it and analyze it and figure out what our targets were. It was a lot of work. It was fun. It was interesting. It was exciting. For me in that age, I didn't have any money. So I was playing with kind of borrowed money. And then people that were around me watched and said, hey, can I get in on this? And we didn't even realize that I wasn't good at it yet. It was like the third or fourth deal we had already owned by the time we sold. The first one I did, I made money, but I decided we needed a realtor. If the realtor helps underwrite the properties, I'll be in a better position to make buying and make it more efficient. Well, the realtor figured out after a week or two of me saying, no, that's too high. Well, we'll just say the ARV or the retail value is higher, then Chris will buy it. We'll get a listing. So my second and third deals, I was like way underwater on.
Right.
I didn't understand, you know?
And so you're going in this as a kind of like, you know, trying to figure it out, young guy, and there is no education out there, and you're learning this while you're doing it, and you're going to have your bumps and you're going to take your lumps. When did the lending component kick in? Because you said that there was a high net worth investor in Phoenix that said, "Hey, I'll lend you some money," or something like that. Is that how it started? It
was in 2009.
Okay.
So I started buying in mid to late 08. And by the end of 08, I provided a service. I bought a Prius. I wrapped it with a bidding service. And, you know,
you were now very professionalized by then.
Oh yeah. I was paying $3,000 to these guys to buy me a house.
Right.
Like that was the buy fee. You pay $3,000 for somebody to stand there. And I bought 3 houses in about a month, and I'm like $9,000 to go stand there and say, I'll pay this much. Like, that's not going to work for me.
Right.
So we started a bidding business. I cut the price in half. I wrapped the Prius with $1,500 bid fee. I put stickers at every house that was a good house every day, you know, $1,500, quit paying $3,000, and kind of built a customer base. One of those guys said, why aren't you lending? And, you know, ironically, one of our other friends, Noah Brocious of Capital Fund.
Yeah.
That's about when he was starting. So, you know, it's a small world. That's why Noah and I know each other, go way back. So we started lending money, and that facilitated more auction business. And we ended up getting some institutional clients that were like Wall Street guys that were early, you know, kind of going in and buying.
This is in 09?
That was probably in 10. So we started lending in 09.
This is interesting because there's been a theme on the show, right? Wall Street didn't really jump in until like 15. So tell me more about that.
That's not accurate at all.
Tell me more about that. How did that play out?
Yeah. So I think the earliest guys were some guys that came out of the West Coast, the Bay Area, actually. And they started buying up in Phoenix. There's an area called Maryvale. It's kind of it's central Phoenix, urban neighborhood, not a high-end area. And the houses were 200, 300 grand in 08, 07. And they were down to like 15 to 25 grand.
Oh, wow.
I mean, these things just cratered. And we had a guy who showed up and he wanted to buy those, and we were buying 2 or 3 a day. And there was kind of a demographic of people that would typically buy and trade in those. And it was like it's a kind of a Hispanic area. And those guys were getting pissed at us. Why are you buying the houses? You're coming in and overpaying. And we're like, we don't know. We've got this guy. He wants to buy them all. We think he's an idiot. He doesn't get it. $20,000 house. He's going to lose an AC. It costs him a quarter of the house. Well, he had put a fund. He was one of the early guys. And the other group that we worked with at that time was called Treehouse Group. Have you heard of them?
Yes.
Treehouse Group was later backed, and I think this started in 12. They were backed by Blackstone in what has
They're on the buy side though, right? They were buying the houses.
They were buying here and 28 other markets, but Blackstone came and put $1 billion behind them, which stretched.
Yeah, that's true. Actually, the point where we were talking about on the show has always been about the lending business, them jumping in on the loans, but buying houses. Yeah. I mean, I think I started seeing it in 12.
Yeah.
We had clients coming up to us in 14 saying like, I've been buying houses for Blackstone or BlackRock or some rock or some stone for the past few years. Like, yeah, that was definitely interesting because they're kind of doing it now. They're doing it again, but like,
Oh, my friends bought. I talked to my friend on my way to the office today. He's still buying on behalf of the institutions. He's bought 70 homes this week.
That's crazy.
In Phoenix, for instance.
Oh my goodness. So 2012. So there's active Wall Street capital buying homes, and it's just in the market, right? And you guys are clearly doing well. At the same time, you're making loans. Right.
Yes.
So you're still kind of following the track of a lot of our listeners and clients, and a lot of our success stories is, you know, home, like basically real estate investor turned, hard money lender back then. And it was truly hard money back then. when rates were 12 and 2 and 13 and 5 and that kind of stuff. It was, you know, and when did the lending business really start like getting serious, start taking off as opposed to like a loss leader approach?
So it got real serious in 2009 because we got a letter from the Department of Financial Institutions saying you need a license for this.
I remember that. Anthony was telling me because he was part of the lobbying effort early on when it came to the licensing rule change in Arizona. And,
got it.
Oh my God. I mean, the state of Arizona. I mean,
yeah. So they force us to get licensed. After we got licensed, we put a fund together. We registered a PPM and raised the money. Yeah.
For private lending.
Yeah. And that was probably in 11. That was our first debt fund.
Dude, you're like one of the old heads, man. That's awesome. There's not many, a lot of lenders from back then, not many of them around. A lot of them have shifted gears, gone to other industries, gone to commercial.
So that's cool. Fund paid our LPs 12%.
Wow.
And we were originating at 18.
Yeah.
And keeping the fees.
Yeah. Yeah.
And that went well.
Just in Phoenix too, right? It was just
local. Yeah. Just in Phoenix at that time. And it went well through about 14 when our rates started to just crater. And, you know, we went from being a market, you know, in 2000 to 2008, where you could charge 18 and 5 to now we're a 12.9 market, you know, inside of just a few years there.
Yeah.
And it just didn't pencil to keep the money out in that situation. And then
12, it didn't make any sense. Starting 13.
Yeah.
When things started to get pretty frothy.
Yep.
Yeah. It was tough to keep up with, you know, some of these more, that was when guys started going national, right?
Yeah, exactly.
We started seeing some banks and, you know, financial institutions back some different groups and rates started to climb down. I remember that, but it was still, you know, double digits. And then nowadays, I mean, where I am, it's like, we saw first and 7%,
7, 8. Yeah. And you know, we were irritated when we dropped down to 10 to 12 to match California, frankly. But we shut that down in 14. I think we wound that down because it was just, we were chasing the bottom. Just pencil at the time. Now we never quit lending. We just kind of reverted to what a lot of hard money lenders do before they get their fund going, right? We would find a borrower and we'd find an investor and we'd pair them up and keep a spread. And that's actually what we did from 14 through, you know, I guess mid 20 when we started.
It makes sense though. I mean, it's a transitionary period from a lot of perspectives, like especially considering how early you started.
Yeah.
Right. Because you didn't jump in when rate compression started. You were in the game. Yeah. We're talking, you know, 15, 18%. So it's kind of like, how do you pencil this long term? Right.
Yeah. And it was influential for me because a lot of my clients at that time were guys that had lost a lot in 08 and were kind of starting over. And then they were borrowing from me. So I had a lot of guys who were a lot more experienced and intelligent in both real estate and banking than I had been at the time, that were kind of, you know, they were customers, but I got relationships with a lot of those guys and learned what they were up to and what worked and what hadn't. Even some of them, one of them, a notable one in Phoenix, was a hard money lender. Wells Fargo had given him $100 million line, and the whole thing blew up.
Yeah.
I mean, he'll never.
I remember when Wells Fargo gave those lines out. It was, you were really, really cool if you got that line, but then all of a sudden they all kind of fizzled out. Those lines were tough. But let me ask you this though. So we've covered kind of the 30,000 foot view of Hanson Capital story and lending. Now, right now, currently, you guys are very active in building and investing in multifamily and industrial real estate, and we've worked with you on that side of the business. When did that start for you? Because you're a home builder. You're buying houses, you're building houses, you're flipping houses. When did you start realizing, okay, multifamily, commercial real estate is where I should be concentrating on?
So there's one more ruffle in this. So I was always a big fan of the real estate side of the business.
Sure.
And it wasn't until, I was wholesaling and buying multifamily units. I've bought and sold about 3,000 multifamily units. And during that same time, like 12 to 14, 15, I was buying doors in Phoenix for 10 to 15 grand. And I could tie up a building for $2 million and resell it for 2.2 million bucks, like before I had even closed on it. So I was always more focused on real estate. And it was in 14, as we wound down the fund, I took on a partner, Tiffany. She wasn't a partner then, she was an employee. And I had her kind of focus on the lending business while I continued to do the real estate stuff. And then I would fund the lending business with the extra money, because as deals got tighter, well, now I'm sitting on a bunch of cash. I'd keep deploying it into lending.
And in 14, multifamily value add was on fire. It was awesome. Yeah.
It was really good. And so, the business, the banking business was good. I think we got licensed in California in 14, actually. So we were lending in California and Arizona, 14 to 16. I got approached by a private equity group in 16 that was looking for capital, like kind of a hard money lender startup, some guys that were from conventional banking that were getting into the business, and some VC guys that merged. There was 4 partners, and I won't name names because it didn't go how they wanted it to. I sold them our lending business in 16 and went full-time real estate. I sold them Tiffany with it, in a sense, because I sold them the whole company, all the staff. We had like 15 or 16 people in the company at that time, and 8 of them were lending, 8 were real estate. So
you're just ahead of the curve on everything. I mean, selling companies, it just started happening mainstream. This is awesome. I mean, so we were one of the first people to sell their business in our space.
Probably. And it wasn't a big number. I mean, it was a 7-figure number, but it wasn't an 8-figure number.
Right. But it's still the fact that it happened, right? Because it wasn't considered, it wasn't even discussed that early in the space.
Well, yeah. And I mean, back in the early days of lending, it was such a cottage industry, right? You didn't have a lending home or any of these kind of big tech-backed groups. It was all private guys. It was actually private lending. Now we kind of still carry the name, but it's.
I mean, 14 and 15 when you started, that was like, I always joke about the advent of crowdfunding and fintech, right? And then they started coming to our space, and
it was the Jobs Act, right?
Yeah. 14 was the Jobs Act. 13, 14 was the Jobs Act, and then the advent of crowdfunding, and we saw a bunch of VC-backed companies emerge. Some of them made it, some of them didn't make it. A lot of
so these guys loaded up. These guys loaded up. The company was producing a lot of money at that time, good, healthy portfolio. And these guys loaded up a bunch of corporate overhead and 6-figure salaries for all the partners and everything. And then they just fell flat on their face on the fundraising side. So, and you will appreciate this with the legal background. Zach, who's in-house counsel for us now, helped navigate my side of that transaction.
Nice.
Their counsel put a clause in there that said, hey, if there was a carryback component, if we don't meet a couple of, these covenants over the first 12 months, Chris has unilateral decision-making to unwind the transaction. And for no penalty either. Substantial down payment, that's his to keep, I'm like a very aggressive term.
Right.
And at the end of the first year, probably like 2 weeks before, I was doing our taxes, and our CPA was like, hey, I've got to write down the balance of this holdback note because you didn't apply an interest rate to it. You just let them pay an earnout. And I'm like, geez, that's odd. Being a banker, I probably should have applied interest. So I sent them an email to check on, hey, how are we doing? They weren't very far off. I think it was several $100,000 they had to pay per year. And they were just a little light. And they said, they took my email, which was just hey guys, let's circle up. How can I help?
Right.
They took everybody in the company in the conference room and said, Hanson's taking the company.
Oh,
are you on his side or our side?
They overreacted.
So all these people leave and I get all these phone calls and text messages like, you're taking the company. And I'm like, I don't want anything to do with banking. They're like, no, I'm not taking the company. Well, that kind of, once they rang that bell, we had a couple
Yeah.
more conversations, and then Zach and we got some other counsel. They said, hey, if they go make a deposit today, you lose that right. And now you're kind of conflicted with these guys, not real bad, but we think you should exercise that option and then go continue the conversation. So I did. And we went and finished the conversation. And long story short, their funding hadn't materialized anywhere near the extent that they thought it would. So they weren't going to.
You were just sitting there asking a small question. It was
just a basic inquiry. Hey guys, can I help? Like, I know you, because I was a partner. I still owned part of the company with them. Like, I was an LP to them essentially.
Right.
I was still, I was on their board. I had some involvement. Well, long story short, I got the company back with like $2 million in the portfolio or something. It's just like they ran the thing into the ground. I got Tiffany back. I made Tiffany a bigger partner, a substantial equity partner, and we rebuilt the company. And that was at the end of 17. We've been, 18, 19, 20. We've been really after it.
Let me ask you this. What was it like to jump back in 17? Because the market was so different in 17. I mean, it was a weird time. I honestly believe 17 was the weirdest year for me, because you had this, like, you had these crowdfunders and fintech companies causing all kinds of havoc, but you also had the institutions buying up a bunch of paper.
Yes.
And so it started to look a little bit, it was a kind of a weird time. It wasn't what it is today, where a lot of the fintech companies kind of exited the space. What was it like jumping back in?
We were a little more hybrid at that point. Like, we actually, we loaded up some brokers, got some MLOs in the shop, and we did some brokering instead of just originating our own funds. So we kind of ran a hybrid to, like, the Civic and Athos and those kind of groups. So we ran a bit of a brokerage model while we picked up steam with our own capital. It was a company that I didn't want when I sold it in 16, because I wanted to be the real estate investor, but it was a company that I got back in 17. And this was like a year to the day. So I had a year off out of the business. And then it was like, I didn't like that. I like having a lending company. I like being involved in the lending space. So I missed it. Now we'll never get out. We'll never get out again.
So you did miss it. So it was nice to get back in.
Yeah. It was very energizing. I had renewed enthusiasm, and it was kind of like, you don't realize what you had until it's gone.
Right.
Situation.
Right.
And like coming to your guys' event in Vegas, like, I love the space. We love the industry. It's a very simple business. At a high level, it's a simple business. We're arbitraging capital. We're fulfilling.
It can be a simple business. Some guys overcomplicate it, in my opinion. I feel like this industry is getting a little bit overcomplicated to some degree.
Well, we had a lot of years to figure it out.
We did. It's been 20 years now since the space has been, but it's it still needs to figure where. I mean, there's still a lot of confusion. I feel like with new products coming in, I think it causes the confusion. Right, this whole DSCR craze is, I think, throwing us for a loop a little bit, because we were private, we were short term. Everything we were doing was short term, and then all of a sudden now this permanent financing jumps in, so it causes us a little bit of kind of like, what is going on? Who are we? Identity crisis, right?
It's been interesting, that DSCR product, for example. There's a lot of new stuff that's hitting the market, and you've just got to be able to adapt quickly, figure out if it's going to fit into your product offering, figure out what your real value add to the marketplace is. One of our slogans is, we make money easy. Right. And that is twofold. We make it easy for borrowers, because we've been at it for a long time. We have our processes down really well. We service in-house. Some groups like to, outsource. Some groups like to run really lean. We like to have the whole team in-house and kind of own the customer experience from start to finish, from they make a loan inquiry to their payoff. They're dealing with somebody in our office. They get to have those relationships. We're just a relationship-driven group. Right. It's fundamental to kind of how.
And I noticed that when I met your team, it's like you guys are very focused on that. You want to be in control of the borrower relationship and the investor relationship. And, a lot of folks have taken the third party route, and you guys have done the hard stuff and building it internally. And is that also ring true on the real estate side? Because that's a much heavier lift, right? It's a very complex business. So you need a lot of people when it comes to running an equity shop. I mean, it's just
I will say I'm historically a multifamily guy.
Right.
We use third-party management for multifamily. I also have assembled portfolios of SFRs, residentials that are different places. I use third-party management for that stuff.
That's property management though, right?
Yeah.
Okay.
Property management, I have been reluctant to take in-house. I have a lot of friends that own thousands of doors, and I feel like they're split 50-50. I think half of them are solidly, you can't use third party. Nobody cares as much as your own employees will. Like, it's got to be a team effort in-house.
Right.
I have the other guys that say, hey, it's got to be third party, because if I own a business and I'm raising LP money, property management is almost conflicted, right? Because they make money. There's maintenance people involved. Like, they've got to make money out of that business. So I kind of lean on that for our multifamily stuff. That
makes sense. It's a common strategy. I would say. Yeah, I would say.
Because then we're aligned. We're really big on alignment. With everything we do, we want our partners to be aligned. It's great that they trust us with their millions of dollars, but we want them to know and sleep well at night that, hey, Hanson is on our team because he's got a carried interest. He makes money when I make money. He doesn't also own the property management company that's making money off me every time he turns a unit, right? So I kind of subscribe to that method, but it's difficult to get the result I want from a third party. I have friends who have thousands of doors and they've got a 3-man team and they just manage the managers. And then I have friends who have 150 employees to manage 2,000 doors.
Right.
And, they're all making money. They're both right in their own ways. So it's different. We like to control the accounting. We like to control the money. We've got CPAs in-house. We've got legal in-house. Our industrial stuff, we generally manage internally, because I'm sure Kevin, but a triple net industrial single tenant deal is a little easier to manage.
Pretty easy. That's probably one of the best investments to be in right now. One of my clients told me, Kevin, don't buy houses. Don't just buy it. If you can do it, triple net industrial single tenant, you will ever be happier. If you can get your hands on it right now.
The returns that we see out of the industrial fund that you guys put together for us, I mean, the returns that we're projecting for our LPs are like high 20s, low 30s, and we're being so conservative. I can't hit that. I can't hit that in the debt space.
No, unless you're levered to all hell.
I mean, even then, at 10%, if I'm originating at 10. Right. I'm not going to get 2-to-1 leverage on that.
Oh, it's happening, my friend.
Where's the intro? No,
you don't want.
We use lending as the conservative bucket.
Exactly. You don't want the leverage. I mean, that there's some pretty aggressive leverage happening. It's transitioning away from other industry sectors, looking for yield, and it's starting to get a little frothy on that side of things too. Because as you know, there's leverage everywhere now, and it's starting to get aggressive on that side. They want a product. I hope you're enjoying this episode so far. Before we move on, I really want to tell you about a great sponsor that's joined us for the show. Private lenders, this one's for you. If you're not currently automating your internal operations, you're likely spending a lot of time on tedious manual processes. If increasing efficiency and generating more business is your company's goal, automation is the answer. Recently featured in Forbes and Entrepreneur Magazine, Mortgage Automator is a complete loan origination and servicing platform designed specifically to optimize your processes and automate your tasks, including all of your communication with the various parties involved in your transactions. It can help you generate and send off documents, such as term sheets, in seconds for digital signing. It's also able to handle your payments, collections, accounting, and so much more. Focus your team on growth and let Mortgage Automator handle the rest. Go to mortgageautomator.com to book your personal demo and find out how Mortgage Automator can help your business grow. back to the industrial stuff right now. I like to get your thoughts on this. We don't have a lot of folks that invest heavily in industrial on the show. It's mostly from a lender standpoint.
Yeah.
On the industrial, like, where are you guys allocating capital? Are there certain subsets of the United States that you prefer? Because I've been told by a lot of professionals, like, if it's just industrial in the U.S. right now, it is just bonkers. Or is that more within certain regions?
So I take a macro approach of I want to have exposure to the Sunshine States. Okay. I've always liked that. States, that phrase didn't even exist until 2 years ago, right? Yeah. I mean, I'd never heard it before that. But I like following population, because for me, real estate is all supply and demand. Doesn't really matter what anybody tells you. If you got a place that nobody wants to be, you can build the nicest thing there and nobody's going to buy it, right? And Phoenix has been lucky. Phoenix was kind of the shining star during COVID. Same with Florida, Texas. I subscribe to this theory that as our baby boomer population kind of ages out of the workforce and really gets into retirement, they don't want to shovel snow. So there's kind of a demographic shift or geographic shift from the northern states to the southern states. Yeah. And that has been bolstered by, I think, an aging population and a whole number of other things. So
you're looking at density dynamics and geographic shifts for individual people. Yeah. Are you looking at the same macros when it comes to, for example, like corporate decision making? For example, like, whenever Amazon puts a bid out, right? You start seeing investors starting to speculate on, which city, and they start allocating capital, and then they kind of like, feel stupid when they miss the mark. Or, we started seeing the same thing with when Oracle shifted gears, or Tesla said we're going to announce a factory here or there. These kind of things, like, are you following those macros? Because that can be more of a challenging thing to follow, right? Because it's kind of speculative.
That's more speculative. I'm not a speculator, Kevin. So I have a very simple approach, two-part thesis to industrial value add, two components. If it has these two things, I'm a buyer. And we are cleaning up, and we're getting a lot of industrial brokers and smart money going into that fund you guys helped put together. We want to buy infill product that is below replacement cost, because as pricing gets silly, residential, good point. Right. It's way over replacement cost right now. Yeah. Things always tend to equalize or come back to equilibrium at some point. I want to buy below replacement cost, and I want below market rents. So I take a patient approach. We will do any lease term from 0 to 5 years remaining with the rents below what the market is. So Phoenix rent is, and I just know this stat, CBRE put out a report in March, which is surely outdated at this point, but 5-year anticipated rent growth for industrial real estate is 37% in Phoenix, which is better than 7% a year. And that's, it's probably increased since then. Yeah. So we throw out the rent growth, but we take that top list of industrial markets, and we know why Arizona. So I'm giving you a long-winded answer, but I pay attention to the news, but I like to break it down even easier. California is too expensive. Arizona is a lot cheaper. Yeah. The truck time of running from the Long Beach port to Phoenix, they can make that round trip in one day. Yeah. So if it's 5 times the price to buy industrial real estate near the port, and it's 1/5 the price in Phoenix, we're going to start having companies that see that makes sense.
It's already happening.
The occupancy cost, right? Like that's why Phoenix is booming.
I've already spoken with like people. I have some friends in e-commerce, and they're shifting gears to like Phoenix, Nevada, not Las Vegas, but outside of outside Las Vegas. Yep. Because it makes shipping times are practically the same. They can Amazon
and they make up that transport cost. It doesn't cost anything.
Right. Cool,
and the trucks going back to the ports are practically free. Yeah, because the ports still need to be there. So they're really only paying a one-way deal. A friend of mine owns a big, multi-state regional recycling company, and he ships all of the paper product that they process back to Long Beach from Phoenix, and it's essentially free. containers. It's like $200, $300. They're like barely covering gas because they need to get stuff back there. Right. And he's a beneficiary, and they put it on the boat over to China for, kind of final processing. So I pay attention to logistics, but I don't take the news of, Tesla's going to be here, I'm going to go speculate and buy up a bunch of stuff.
You're looking at the core macros.
I like fundamental economics. That's kind of my approach.
I like it. I want to shift gears a little bit because we had been on a you and I and another client of ours we're on a podcast, a webinar about Main Street investors. And one thing you said during that episode struck me is that you have a very much like wealth building passion, right, for your investors. It really helps. It really motivates you to build wealth for your investors. I want to talk about that real quick because it's not really a common. We have folks who talk about wealth building as part of their kind of approach, but we don't. They're more money manager types, wealth advisors, asset manager types. They're not real estate people, right? Once in a while, you'll see it from an influencer here and there, but for people in our space, it's not really a common discussion point. Like, let's talk about that real quick. How do you take that approach for your clients? Because is it a combination? Are you looking at both debt and equity, or is it purely real estate? How do you deal with that with your investors?
Yeah. So, unique. I think unique to myself is that real estate has given me so much freedom to do so many things, not only for myself, but for other people.
Right.
And I literally had nothing, like started with nothing.
Credit card advance.
Yeah. Didn't come from the wealthy family, didn't get any of the advantages.
Right.
And I had a lot of smart people that have given me advice over the years, and I didn't always listen to it. I'm kind of one of those guys that needs to go do things, and I had a really smart family office buy a building with me in like 13. And they said, Chris, you got to stop selling these. I could have wholesaled that building, made $400,000. And that would have been all the money in the world to me. That would have been a lot of money to me at the time. Not that it's not today, but it would have meant more. And they talked me into owning it. And they were kind of, I'll say, the start of that concept of like the real wealth is created from owning things, right? Like you can be a good hard money lender or an MLO, if you're getting into the lending space, or good at fixing flipping houses or flipping buildings. All that stuff creates income, but income is you need it, but it's kind of worthless at the end of the day, right? I want real wealth creation that comes from appreciation. Now, I've been lucky to ride a pretty good wave from 2008 through today in real estate. We've played with a lot of things, and that's really where we get the fulfillment is helping people that, are smart people. They make good income, but they don't know how to invest their money.
Right.
And, I think we talked about in Vegas, we keep a metric internally of the millionaires we've created. People who've literally, we're not a millionaire. Now they are, and they attribute that to, hey, I invested 200 with you in 14 and now it's 7 figures, that kind of thing. Right. So I get a lot of passion from that. I bring a lot of people in close to me. As you met a lot of my team, all those people are with me for a relationship, and I'm teaching them that knowledge. And that's the approach we take with our investors is, hey, multifamily development is speculative, right? I mean, with all the stuff going on in the world and a 2 to 3 year deal cycle, that's a risky bucket. But instead of just going to your traditional wealth manager and he says, okay, you're going to put 10% into bonds and we're going to put 20% into blue chips and play that game, we kind of developed our own. And we didn't do it intentionally as we started in lending, in 2009 or fix and flip in 2008. It's just kind of those businesses have matured. We've learned new skill sets as we've matured as a company. And now we use debt as this is our safe cash flow with relative liquidity through the fund. Value add is kind of opportunistic. It's going to do a better return than debt, and it should be low risk. And then development's kind of our risky bucket. So we have that conversation with people when they're interested in investing in real estate. We focus more on what's what's their needs and what their wants and what their path is supposed to look like. And we tell them if we have where we think that might fit into one of our buckets. And if it doesn't, which is not something you'll hear from guys who manage money very often, we'll tell them we're probably not the right fit.
Right.
Because we talk to them about what kind of liquidity needs. Do you have a long-term horizon, or, did you see an infomercial and you want to get rich quick?
Yeah.
If that's your goal, we're not right.
Right.
We hit pretty good returns. We've been on a great run, but we stick to fundamentals, like we were talking about, the macroeconomic stuff. And we take a long-term vision on the real estate side, at least, that if the market shifts down, which we expect it will at some point, we're lower leverage. We don't max out our leverage, and we're prepared to weather it. That's why we focus on our buy price.
Right.
Our business model is not predicated on finding an idiot to overpay.
Right.
We want to own things. And that's kind of the mindset we take to investors and say, here's how we play in real estate. Here's what we've done. Here's what we think we're good at.
And here's how you've succeeded within relative conservative confines. And that's something that's going to keep you. I mean, you already had a long-term career, in my opinion, starting in 2008, but that's going to keep you, 20, 30, 40 years probably. There's some folks in the space that have been here 30, 40 years now. And I see that like kind of approach. I don't know if you met the man at our shows. The legend in California is Uncle Chuck. He's been doing this for 40 years, right? On that side, right? But like he was always telling me like, now that we've been through a couple of times, like I know exactly how to approach these things. And the answer is always conservative, right? Never over lever. Never trying to look for that, that idiot buyer. You're really trying to play it safe, and that's how you keep in this game for a long time. And that's awesome. I mean, I think that everyone who has that approach is going to have a long road of success. And I really wish that for you guys. I think you have the right team too. Everyone's has a very similar mindset, and they're all relatively young. And I'm looking forward to see you guys grow in the space.
Yeah, it's
going to be awesome.
Fun. Yeah. It's going to be great.
I want to talk about the team real quick, though, because, I got to meet, I think, most of them. And Tiffany, man, she's awesome. And Zach, that guy's, a smart guy. What was really interesting, though, was the culture that I noticed. And it wasn't like outward where you see values posted everywhere, but there was a strong culture amongst the team members. They were all looking out for each other. They were always communicating with each other. Talk about the company a little bit internally. Like, what are some of the company cultural aspects that you guys have built over the years? Yeah.
So one of our core values is that it needs to be fun or we're not going to do it.
Okay.
Now that doesn't mean, we don't feel like doing our accounting this month, so we'll just skip it. Right. But it means that we're going to pick things that we're passionate about. Mm-hmm. So like when we decided, it's time to put the fund structure again for debt, and we're going to go after that. That's because we made a decision as a team. And one of the people you met on that trip named Ellery, mm-hmm. Ellery just had her 1-year anniversary with us 3 or 4 months ago. Mm-hmm. She's pretty junior to the team. She's fresh out of college, like early 20s.
She was holding her own. She sat next to me at dinner. She's
a rock star.
And she's very passionate about the business. That was an interesting part about it. And she knew a lot about the business for a first year. That's hard to achieve.
And Tiffany, I'll give Tiffany credit for this. When we were hiring for that role, there was a guy who was several years senior to Ellery. He'd been at a couple good banks. On paper, this guy was awesome. Mm-hmm. But we met Ellery. Ellery was an athlete. She was the captain of her crew team at, oh God, now I'm blanking, a good California university. And we met with her, and it's just like, man, this girl has a kick-ass attitude. We just trusted her. We had faith in her. We only had room to hire one, but we said, you know what? We're going to hire two. We're going to hire the guy that works on paper. And then we're also going to we're going to hire her and give her a part-time capacity. And then, we'll see if there's a job there. Like, we'll kind of give her a chance. If we take a chance on her, we'll see what happens. Right. Well, inside of 90 days, we had fired the guy because he just made horrible decisions. I mean, just downright, what are you thinking? And he had, long story short, we got rid of him. Yeah. And he just had that I can do it attitude. So that's That's a key component of our culture is we want to work with people who get results. They don't make excuses. They ambitiously go after things and figure out how to learn how to do stuff on their own. I'm not micromanaging people.
Right.
Tiffany's not micromanaging. We've got a team effort, and we reward our people internally with company process. So the real estate side of the company does really well. The debt side of the company does really well. And we all work, even though, there's a few of us that take pay from both companies. Ellery's only on the debt side. Chris Pike, Zach, and I get paid from both. But we all work in all the companies because we're all learning. Like our goal is to build wealth through real estate. And Ellery's got a front row seat to, industrial and multifamily real estate. So our company is very flat from an org chart standpoint.
I noticed that. I very much noticed that.
I encourage groupthink. We have a lot of meetings, not to a detrimental level, but we like to bring multiple opinions into it. And the other thing that's kind of unique is that nobody in our business had a background in banking or real estate prior to joining the company. So we look for ambition and attitude because nothing we do is rocket science. And, you get a lot of the kind of career bankers and people in that path that get focused on pedigree and school and which bank they worked at and all that kind of stuff. And that's an employee mindset that just isn't as valuable to us.
You're looking for an owner mindset.
Yeah. I want the self-starter, the guy who wants to own things, So we will be around for a long time. I'll continue to stake the company, but the next layer of the company you met, Zach and Chris are taking over the company. I'm done in a couple of years.
Nice.
And
you couldn't pick a better group. Those guys are awesome. I mean, that was the interesting component of it. Like Zach, I've never seen a company where GC is principal, right? It's very, very rare to see the general counsel is also a partner in the company.
Yeah.
Usually they have their general counsel, or they're not thinking that way. But when I speak, he's has a principal mindset, and it's very rare to find in a lot of companies. I commend you for giving that opportunity to. Was it him who asked for it, or was it just, did you bring him on as a friend, as a partner, or how did that work out?
Zach helped me with the first litigation we ever had to deal with. We had mutual friends, like back in 2010, I think it was the first deal. And he's been kind of outsourced general counsel for me probably since 15. And then his practice, he came from a practice that he was a principal at. So he already had the business owner mindset.
Right.
And he'd been pushing on me a bit to get into real estate. And we work with so many attorneys all the time. Yeah. And, I feel like I'm almost qualified. I could sit for the bar and see.
Probably better than most of us, honestly.
I probably know enough to be dangerous. So, I just said, hey, you don't know anything about real estate, right? Other than the transactional stuff, but you see your side of the invoices and you see my side of the deal regularly. Like, why don't you come give this a shot? And he jumped in with 2 feet. He sold out of his practice and, came and took a role internally. And I believe in letting the people in the team invest alongside me. I lead another core value. We don't ever put an investment out that we're not putting our money into.
Oh, really? Every single one I've
got money in every deal we've ever done, with the exception of some of the loans that we do. Like if they're not done in a fund, if you, the individual Kevin, buy this loan,
it's trusted investment,
right? But I used to have a policy that if you didn't like the loan and you wanted out, like if it defaulted, I'll write you a check, I'll take you out, because I kind of kept lending because I really like when, the default happens. It's one of those situations where if you pay me as agreed, I make money that's good for me. If you mess it up, I make more. So I still offer that. I don't guarantee it anymore, as we're too big for me to guarantee it.
Right.
But I think the culture is so critical that, I've learned a lot of things the hard way. I teach the people in our company the right way, I think, and we have a lot of advisors that we bring in, and we have roundtables with, everybody in the company is welcome to that meeting. So we kind of let people self-select where they want to go. I tell anybody when they start, this is the job you're being hired for. I'm not going to hold you back. If you can add value above that, I have one request. You're going to have to help fill the seat that you're leaving for the next seat up, and that culture kind of, lets people know, hey, I may start at 50,000 a year in processing, but I have potential to create value here.
Right.
It will be recognized. It will be appreciated. And I'm treated as a peer from day one.
You're not creating any kind of caps on there. And let me ask you this, how big's the team now?
14.
Okay. Still pretty lean considering. I mean, you guys are very much, we have to have the level of control you guys want to have. That's still must have a few jack of all trades, guys who can do a little bit of everything. Yeah.
I mean, unfortunately, yeah.
Maybe fortunately though. And as a thing that we've learned here is, as you run into cycles of people leaving and, redundancies are important, right? So
they are. It's critical.
Having someone who could do the accounting, but can also do some processing, close a loan, close a property, that may be useful in a pinch, So
we cross-train our accounting department. Everybody in the accounting. So we have 5 people in accounting type capacities, but like our financial analyst knows how to do the staff accountant work.
Right.
Because, it's just, hey, we also have a very flexible travel and holiday schedule.
Right.
I mean, we're not keeping track of, you've used 3 hours of PTO this month. It's use what you need and get your work done. So we're often around the country and getting done what we need to do and taking care of each other. We've got a great culture. I think that's very important.
And I definitely noticed it. It was for a company that's been around as long as you guys had. I was really impressed with how, not only young and energetic, but also how tight knit everyone was, and a very, very good feel about like they were really having each other's backs. And that's very, very rare to see when you see a company like as long as you guys have been around, right?
Yeah.
And so that's awesome. And you guys told me this in Vegas, but shout out to Tiffany. She like basically is the brains of the operation, I hear. So she's the one that gets shit done.
I'll give her all the credit. She runs lending, right?
That's awesome.
She runs that business.
That's awesome.
I help and I will participate as I'm needed. I focus on fundraising. I like meeting with investors. I like having this kind of discussion.
Right.
Hey, why do we invest in this? What do you like about that? What are you doing with your money? I mean, I live, eat, breathe, and sleep to talk about finance, talk about money, how we can capture opportunity.
Mm-hmm.
That's my thing.
Cool.
And she's an excellent operator and she runs a really good, great ship.
Awesome. Well, I want to shift gears real quick, and we don't have that much time left, but I want to get your thoughts because you're so active. You've been actively involved on both sides of the business. The resi market specifically, it's, in my opinion, I think it's strange right now. It's so white hot. There's so much demand. You see how on fire the DSCR stuff is, and on the flip side, I have mortgage banker friends and clients who told me we're a little bit worried, right? The conventional guys, paper guys. What are your thoughts on, the markets that you're in for residential? Because it's an interesting time.
So I'm in the Texas market, mm-hmm. Dallas, Fort Worth specifically, mm-hmm. Houston and Phoenix from mm-hmm. a residential capacity. And I actually spent the last 2 days in Houston and Dallas with one of our partners. They're named Highland Homes, mm-hmm. Largest home builder in Texas. I want to say largest privately owned in the country. Mm-hmm. They might be the 4th largest in the country, largest in Texas, something like that. But they're going to build 4,000 homes this year. Very, very big company.
In the DFW area only, or Houston? Was it Houston?
No, they're all over Texas. They're based in Houston. They've got offices in Dallas. So we flew in on Wednesday morning to Houston to look at a multifamily site that they're going to build for us. Mm-hmm. And then we flew to Dallas Wednesday afternoon. I actually was with their CFO, Dan Miller. Mm-hmm. He and I sat next to each other at dinner Wednesday. Really, really sharp individual. Mm-hmm. These guys they've been around for and I'm going to get it wrong, 30, 40 years. I mean, it's not a new company. Mm-hmm. They're a longtime Texas home builder. And my partner in multifamily development is also a home builder. He sold to Weyerhaeuser for a very good deal in '08 at the peak.
Mm-hmm.
So I've got a lot of builder network kind of friends, and I get input from those guys when we travel and work on stuff. And I fall solidly into what I've seen headlines the last few days saying the same thing. Residential's on fire. It's not a bubble. So I'll put my flag in the sand on that.
Okay.
I don't see this crashing
Right.
because they look at it from production, historic production.
Mm-hmm.
And right now, with what we're building today, we're only building about half of what we were building in '07.
Mm-hmm.
And the home building wasn't what blew up '08, right? It was our debt.
Yeah.
So the home building engine for the country pretty much shut down in '08. And if you look back at charts from the 40s, you look at the number of homes we produced, dwelling units, right? And that's what we track in multifamily, same thing. Dwelling units produced versus demand of population growth in any market. That's how you can tell what's going to happen with your values. If you ever have more dwelling units coming online than population need, things get soft.
Yeah.
When you've got more population coming in than dwelling units being produced, like we're producing like 25 dwelling units a day in Phoenix right now. And we have 300 households a day moving to town. Weird. Our market is skyrocketing, we're not building at the capacity that we have historically been at, historical average. And I'll get the number wrong. It doesn't matter, but let's just say it's 10,000 units per year. We're at like 5 right now. Mm-hmm. So we're not building at the capacity we need. Now pair that with what I brought up earlier, where I think we have a population demographic or a geographic shift down to these markets. That's just exacerbating the problem in those markets. So I think residential can have challenges in certain areas. I wouldn't want to own in Michigan, right? I wouldn't want to own in the Northeast and some of those kind of areas that are struggling economically. But I'd love to own in, California is always good, right? I mean, there's just so much draw there, but Carolinas, Tennessee, Florida, Texas. I mean, anything in the South where we have population that's shifting there, we're going to continue to need housing.
And that's been the debate, right? It's always been the debate on like the builder's perspective, like inventory, right? We have inventory is a problem. It's never going to be solved. We're not building enough units. On the flip side, from the mortgage perspective, though, it's so frothy. Rates are weird. I can't say anything else but weird because they're up and down. And then you have this DSCR product in our space that is going to explode. I feel like my prediction for it is like we're going to see like Loan Depot jumping into it eventually. It's a foregone conclusion.
We're going to see what?
I think like Loan Depot is going to jump. Like the major paper shops are going to take it themselves, and it's going to be.
That's
I hope not, but
scared. I would get more scared at that point. But I mentioned my buddies who bought 70 houses this week on behalf of one institution.
And that as another point I mentioned on another episode is like the institutions are buying up a massive quantity of rental homes,
and they still don't have a fraction. I mean, they have like 1% of rental units.
Well, you see that in the news, right? When BlackRock buys a small city in Texas, like it starts to make you like, what's going on here, right? It's they're starting to buy up. Are they trying to make us into a nation of renters? And that is what frightens me. Of like, is it going to be some kind of weird eventual crisis? Not like '08 with a credit crunch, but like, is it going to be a weird ownership crisis?
So for years of being a guy who sources and does acquisition and resale to institutions, I can tell you since that got big in like 12, I'll say is when it really picked up steam. There hasn't really been a period where we've ever been able to satisfy the demand of those institutional buyers. And I can tell you from knowing guys who work, platforms for Blackstones and BlackRocks and things like that, those guys have capital they have to deploy, right? I mean, they're going to deploy it, and they're calling going, how do we we're going to change the underwriting model. Now instead of needing a 4 cap, we're going to drop to a 3.7. Now the new buy box is 3.7. Go get inventory. So you have these just giant pools of money that are trying to get into the space. And I think that's why, you can say the housing market as a whole, but that's not really the picture, right? That's a USA Today headline. Hey, the housing market's up 17%. Well, a $5 million house in a luxury area is probably not up 17%.
No, it's not.
And, a $300,000 entry-level home probably is up 25%, right? So when you get into general statements, I think you can get into trouble. But the lower end of the housing market, where I think we have the most exposure from having people without equity, is going to get more of this kind of less equity in the game, less skin in the game transaction stuff. And my opinion from the institutions I've worked with over the years is if that ever crumbles, there's going to be a vacuum of money waiting to pick up distress there. There just isn't distress there.
That's true. They are getting ready for it. Everyone I talk to on the distress side is getting ready. They're never going to actively say they're ready to go because there's not much deal flow right now.
Well, everybody got ready for all the distress from COVID, and
I remember that. Yeah.
Tell me how those funds are doing, right?
Thankfully, we didn't have a crisis in that regard.
Well, that's because we just printed more money.
True. That's true.
Right? Which is another reason that's bolstering prices. So I don't know. We could talk for hours on the inflation concept and where all that goes, but I feel like housing is still a good place to keep money.
And that goes to our final question for the show. We always ask at the end of the show: bullish, bearish for private lending, right? Private lending as an industry.
Yeah,
next 3 years. What do you think?
Bullish. I mean,
all right.
Continues to get good technology and good money. Smart money is entering the space. Now that could be hard on the small guys and the guys trying to break in because as the leaders get more established and more efficient, that makes it hard. And I could be in that group that gets pushed out, unfortunately, as it gets more mainstream. I don't think that'll be the case, but that could even be a
good point. I was thinking about that. Like, is it as it becomes standardized and commoditized? It used to be really easy to jump in if you were a new lender. Now today it's a little harder.
It is.
It's easy to fund, but it's still harder to kind of like grasp the concepts now.
Yeah,
I feel like it's going to get harder and harder over the years.
Well, and mortgage banking. As we get more groups that want to put bigger chunks of money, like I saw some of the guys at your guys' conference, and I've never been a big conference attendee. I like to go check them out, and if I'm trying to learn a new space, but I saw the guys that were reminiscent of me 10 years ago. They run a small hard money lending deal. They're getting into the space, but they have no idea how much they don't know, and it's a tough time to enter the business. When I got in, anybody could do it. Yeah. Oh, you want to borrow money? Great. I can find some money. We'll lend it to you. It was so easy compared to today.
Yeah.
Now you've really got to show up with an A game and have some sophisticated, banking and legal understanding, or it would be a hard, the barriers to entry, they didn't used to be there. We used to say there's no barrier to entry. There sure is today.
Yeah.
I mean, and I think that only gets worse.
Okay.
So bullish on the industry, but maybe bearish if I was an individual trying to
jump in.
Yeah, go plant a flag and create.
We need more of those educational resources. There's some groups that are doing it for new lenders, but definitely need to encourage it because the market needs to grow, and we only grow by having new operators jump in and new things. Well, cool, man. You know what? This has been a fun one. I always enjoy talking to you, Chris, and I really appreciate you joining us on the show here. I think it's all the time we have for today. And for our listeners, this is probably going to be out a little bit after our Captivate show. So if you were there and you met Chris, it'll be a good time to catch up with him here. And we'll see you on the next one.
And thanks again for having me. Really appreciate it. And anybody listening can find me at hansonre.com.
There you go, hansonre.com.
Thanks, Kevin. Talk to you soon.
Thanks for listening to Lender Lounge with Kevin Kim. I hope you enjoyed this episode as much as I did. If you did enjoy, please leave us a 5-star review on your podcast platform and be sure to follow our show to be notified of new episodes. If you're on YouTube, don't forget to smash that like button and hit subscribe for more content from all of us here at Gerasi. Lender Lounge with Kevin Kim is available on all podcast platforms. Referrals really help us spread the word, so please send this over to someone you think might enjoy it. See you next time. This is Kevin Kim signing off.